everyone. Today we'll have a look at the top mistakes on using family trust for property ownership for investment. All right. Okay, before we go to the main content, a quick declaration. The information provided is for general guidance only and should not be construed as personalized tax advice. We strongly recommend consulting a qualified tax advisor or planner before implementing any tax planning strategies. Please also note that we're not licensed financial planners or legal professionals and do not provide financial product or legal advice. For tailored investment or legal guidance, please consult a licensed financial planner or a qualified legal expert. All right, let's have a look at the content. Okay, introduction. Basically, the main purpose of today's session is we want to have an overview of family trust in property ownership. And family trust is quite famous for its benefits. Yeah, it happens quite often when a client come to us. They'll just mention, "I want to set up a family trust to purchase a investment property," but without understanding the impact. Okay, so of course it's good for asset protection, tax planning, succession planning, estate planning, etc. But also there could be possible mistakes, and that's the main purpose of today's session. All right, top mistake number one: incorrect trust structure. Okay, so sometimes because when we are talking about the trust structure, it can either be a family trust or a unit trust. Unit trust can also help you to potentially claim a tax deduction when it's a property loss. Okay, and but for family trust, you can't claim a loss. We'll mention later. So you actually need to understand what you want to achieve before you set up a structure. This is actually applicable to any ownership structure. But when we are talking about trust, within trust structures, there are different trust structures as well. Okay, so the main mistake using a discretionary trust, when a unit trust might be more appropriate, or vice versa, depending on asset use or investment goals. Impact may limit the flexibility of income distribution or expose the trust to higher taxes or land tax surcharges. Yeah, land tax is one of them that we have to consider before we set up a family trust. Yeah, because normally when a property is attached to personal names, there's you can have the tax-free threshold for land tax. Okay, but with a discretionary trust or family trust, you actually lose that privilege or that concession. All right, but some unit trust, if you set up correctly, you don't have to pay land tax. Yeah, when you're below the threshold. All right, then the possible solution: carefully assess the trust type with professional advisors based on long-term plans for the property. Yeah, depending on what's your goal, financial goal. If your main goal is to achieve short-term tax deduction, then maybe a unit trust, yeah, or maybe even consider different structure, like individual ownership. All right, okay. Misunderstanding on stamp duty or capital gains tax. Okay, the mistake is transferring property into a trust without correct considering the stamp duty and CGT implications. Okay, the impact: these transfers are generally treated as sales at market value, triggering large tax bills, but it could still be worthwhile for long-term planning strategies. The solution: use exemptions where possible. Plan transfers strategically with cost benefit calculations. Okay, so basically this one, you have to know or understand your cash flow, how much capital gains tax is going to be when you're transferring property from individual ownership to a trust. Okay, and of course, but on the other side, it's not that you can't do the transfer. That's actually a common mistake. Quite often, actually every single year, we would receive clients because either from their accountants or from their friends, they mention that they have to pay a big cost upfront. Then they're not willing to transfer a property to a family trust. But sometimes through calculation, it might be still a good idea. Because let's say if you have a property you plan to hold for 20 years, where is the best moment to transfer it to a family trust? You might want to do it 20 years later, but then you also have 20 years of capital gain that's attached to your personal name. Then you have to pay capital gains tax. Then, yeah, with 20 years of accumulation on the property value increase. But then also you can choose to transfer it in 5 years. And then you pay less capital gains tax, but when your family group come in to share the load, you're going to pay much less in 20 years later. Okay, and then even reduce it to 0% tax. So that's actually some critical considerations. It's not that you have to pay the cost, then you don't do it. It's the timing, also strategy. The strategy side is you don't want to transfer all properties together. Let's say if you have 3 properties, you don't want to do them together in 1 year because you're going to have a big capital gains tax bill and also stamp duty bill. If you split the asset in different years, okay, pick and choose different assets, you can actually even up your capital gain. All right, that's number 2. Number 3, okay, main residence exemption. Okay, this one, when we're talking about it, is actually, generally speaking, property has to be attached to personal names before we can claim capital gains tax exemption. So that means when you're transferring main residence property or potentially a property that you could treat as main residence, when you're meeting the 6-year rule requirement, but once you transfer to a family trust, you lose that exemption. So that's something important you need to know before you do the transfer. All right. Okay, number 4, land tax surcharge and loss of thresholds. That's what I mentioned earlier. Okay, the special trust. It's a mistake, not factoring in that land tax rates for trust are often higher. Okay, and the impact, significantly higher annual holding cost. Solution: register the trust with the relevant land tax authority and avoid appointing foreign beneficiaries wherever possible. Include costs in analysis for decision making. So when you are doing the initial cost benefit analysis, you want to find out, okay, let's say if you do the transfer now, how much land tax you're going to pay. Of course, you also pay initial cost, capital gains tax, stamp duty. But then in future years, you might be able to save enough tax to cover all this cost. So that's where we actually need to do some calculations before we can make the decision. All right. So number 5, rental loss can't be distributed. Okay. Common misconception. People think or believe that the family trust can also distribute loss. That's not the case. All right. So that means if you want to use a negative geared property to reduce your personal tax, you can't use a family trust. You could potentially use a unit trust, but not the family trust. Of course, unit trust doesn't have a lot of flexibilities a family trust would have. Okay, the impact. Rental losses are quarantined within the trust and cannot be offset against the individual's personal income. These losses can only be utilized in future years when the trust generates sufficient income. Okay, solution: carefully evaluate whether a trust is the right structure for your situation, especially if your primary goal is to reduce personal tax liability. All right. Okay, number 6, not non-compliance with the trust deed. That's actually one of the major issues we're facing when we receive new clients. When a family trust is actually set up by someone else or by themselves, maybe they're not utilizing the best trust deed on the market, and then our hands are tied. When the trust deed is not allowing some tax planning strategies, then we simply can't do them. Okay, so the mistake: acting outside the power granted by the deed. Okay, distributing to beneficiaries not listed, for example. The impact could invalidate decisions, attract penalties, or disallow tax treatment. Solution: prepare thorough trust deed to incorporate future planning strategies. Always consult the trust date before any significant action in the future. All right. So talking about that, I would strongly recommend utilizing, say, for example, with our trust, we have 45 pages in total. Sometimes when we receive clients' family trust, when we have a look, it's 10 pages or 15 pages. That means it's not a thoroughly prepared trust. A lot of tax planning strategies, a lot of critical concepts, they might not get outlined in the family trust deed, then it's actually limiting our planning strategies in the future. All right. Okay, final advice. Family trusts can be powerful tools for property ownership, but they must be managed with care. Okay, professional advice is essential at the setup and during key transactions to avoid irreversible tax consequences. All right. Okay, and here is introduction about myself and also our contact details. Feel free to give us a call or send me an email if you have any questions. Thank you so much. I'll talk to you in our next session. Thank you. Bye-bye.